would just love to start with like more of like your big picture of where we are in the markets and maybe your outlook ahead.
Yeah, absolutely. So, for those who have been paying attention to the show, it's pretty straightforward. So I'll summarize everything. At 42 Macro, we believe that if you use enough data, use enough math, have enough of a repeatable process, you can sort of harness these sort of big macro cycles that tend to drive dispersion within and across asset markets, and obviously take advantage of that from a portfolio perspective. There's sort of, we consider there to be four big cycles. There's the liquidity cycle. So as if you think about the Fed balance sheet or interest rates, is that getting more positive, more favorable for asset markets or less favorable? Clearly, we're in a liquidity cycle downturn. Our views is we're close to, let's call it inning 5 or 6 on that. For those of you who are not Americans, baseball is played in 9 innings. So, we're probably, let's call it 2/3 of the way done in terms of liquidity cycle downturn. As it relates to the growth cycle, which is another important cycle, we're probably in inning 4 or 5 in the growth cycle downturn. It's set to significantly deepen in the coming months, at least according to our forecast. We're probably in extra innings in the inflation cycle upturn, as evidenced by the most recent headline PCE and headline CPI or CPI reports that we've gotten in recent weeks. And then lastly, I think we're probably close to inning 1 or 2 of the profits cycle downturn. What I mean by profits, we're talking about corporate profits, corporate earnings, the things that will drive, incremental decisions, going back to your previous discussion about, whether or not companies are spending more money on marketing, more money on hiring, et cetera. So we are not in a favorable place to be speculating on the long side of most risk assets as a function of those 4 downturns.
So there's a lot of talk right now about, are we in a recession? I will obviously find out when we get this second quarter GDP print, but what is kind of your thought process there? And like, how do you kind of think about that?
Yeah, so I see you have some charts. Are you able to put them up?
Yeah, we can pull the charts up. Which one would you like us to pull up? Maybe the
first one. So model implied probability.
Yeah, let's pull up the model implied probabilities chart if we can.
Yeah, so this first. So what we're trying to do with these charts is identify whether or not we are in recession or likely headed to a recession over the medium term in some investable time horizon. Anything over a year is generally not investable from a risk management perspective. It can be, you can talk about stuff from a year from now, but it's not going to really matter to markets. So what I'm showing in this top chart, the blue line in the upper panel just shows the New York Fed. That's the Federal Reserve Bank of New York's recession implied probability model, down at 4%, 4% probability of having a recession over the next 12 months. One, I think that number is wrong, but 2, it's significantly lower than where it's typically at on a mean basis. Heading into recession, that number is around 27%. So typically right into a new, recession, that number is on average around 27%. So it tells you a couple things. It tells you, one, at the onset of recession, even the recession probabilities are still generally low. So you need to have forward-looking indicators to give you a better view on that. And then number 2, the red line in the upper panel just shows the a model I put together just based on a couple of Bloomberg models that are anchoring on the 10s, 2s Treasury yield curve and the 10-year 3-month Treasury yield curve. That recession probability is currently around 25%. Historically, it's been on average around 35% at the onset of recession. So that's much closer to signaling, hey, look, we might actually be in recession. But to me, I think the discussion around recession is really coming from the consumer. The second chart I sent you is consumer confidence.
Yeah, we can pull that up too.
Yeah, absolutely. So the chart, the top upper panel in that chart shows the blue line just shows Conference Board's consumer confidence measure. That's sort of one of the more stickier autocorrelated consumer confidence measures that we have. It tends to be more correlated to the labor cycle than the University of Michigan survey, which is also widely followed. That tends to be more correlated to inflation. But the key takeaway on this chart is that historically, when you've seen consumer confidence break down below its trailing 3-year average, you're typically in or just about heading into recession. And very clearly, with the most recent data point we got yesterday, I want to say yesterday or 2 days ago, 99. I think we're now careening well south of the trailing 3-year average, which takes me to my final chart, consumer expectations. This other chart, consumer expectations, sort of breaks into a couple of different indices within that consumer confidence report. Again, these are June data points, so they're pretty relevant, they're pretty fresh. The red line in the top panel just shows the present situation index within that Conference Board consumer confidence report. The blue line shows the expectations index. So how do consumers think about what's likely to happen over the medium term? And as you can see, there's this massive divergence between how consumers think the economy is today, how they feel about the economy today relative to where they think the economy is going to be in the future. That's denoted by the spread there down at the bottom panel. Now that spread at, minus 80, 90 basis points wide to the negative side is about as deeply negative as it's ever been. It's in the first percentile on all the monthly readings since going back to the late 60s when these indicators were born. So that tells you that, as you can see where those red bars are in the chart, historically speaking, when you get to a very deeply negative spread between consumers' expectations and how they currently feel about the economy, you typically are walking into a recession, because that's typically how it happens, right? You start feeling bad about the future, and therefore you adjust your current spending, your current expenditures, et cetera, to how you feel. And this is all part of the behavioral dynamic associated with, economies and financial markets called prospect theory. We don't need to get into that now. Definitely go check out Danny Kahneman's book, Thinking Fast and Slow, if you want more details on that.
I like that. And it's like the psychology of it. I guess like a follow on to that, because like I'm looking at your models, like, is there a way to like assess, how severe a recession might be, like when you're looking at these indicators? Like, how do you kind of think about, like, is it like something that's quick? And I would love to explore that with you.
Yeah, so that's a great question, Julie. So there's a couple of ways to do that on an ex ante basis. One, you could sort of, the easiest way to do that is try to understand kind of the different leverage cycle dynamics. The first would be, how fast has credit grown into the downturn? Historically speaking, whenever you see a significant positive deviation in the credit to GDP metric, particularly private non-financial sector credit to GDP into a downturn, that's what we saw in 2007. You typically get a more deeper, nastier kind of asset price led recession that takes longer to recover from. A second way to explore that on an ex ante basis is looking at looking to observe if you have a positive deviation, a significantly positive deviation from the trend in what we call the debt service ratio. So that's the total amount of sort of interest payments and amortization or paying back debt, for the broader private non-financial sector. And currently speaking, neither of those two indicators are signaling kind of cause for significant alarm, i.e. neither are suggesting that we're likely to have a deep, lasting, prolonged, protracted recession, which is a good thing. Now, the one thing I'll caveat this by saying, the data that, we get this out, we derive those statistics from are released on a pretty severe lag. So we're talking about Q4 21 statistics, and it's obviously the end of the second quarter of 2022. So fast forward 6 months from now, we could be getting statistics for the second quarter of this year that may say otherwise. But for now, just being data driven, we can understand that any recession we are likely to experience over the next 12 months or so should be shallow. In my opinion, I think it's more likely to resemble the 2001 recession, which was, you need a magnifying glass to, kind of really see it on the map. It was the shallowest recession in U.S. economic history at peak to trough decline and output of minus 70 basis points. But guess what? That didn't matter to the market. S&P was cut in half. NASDAQ was down 80% in the span of that, 2.5 year bear market. So you have to be careful not to associate your expected outcomes in financial market terms with your expected outcomes in economic terms. The destination doesn't have to be the same, but the rate of change is likely to sort of perpetuate and feed upon each other.